wanted to start with the leader with the toughest task, the moderator himself, Mr. Babu Nair, publisher and MD, Banking Frontiers. We move on to our next leader, Mr. Satish, Dhupdale, CDO, Light Microfinance. Mr. Satish, kindly come on up. Our next leader is, of course, Mr. Shekaar Subramanian, Head Structure Finance, Fedfina, Fedfina. Our next leader is Ms. Aiswarya Ravi, CFO, Kinara Capital, Ms. Ravi. Our next leader is Mr. Rohit Sharma, Head Business Lending Platform, Lentra. Our next leader is Mr. Jatul, Anand, Chief Credit and Collections Officer, PNB Housing Finance. The last leader for this panel is Mr. Rohit, Chief Risk Officer, Tata Motors Finance.
So, let us start with the basics. The business of lending has seen a splurge in the recent past, and it has also transformed. So from the recent past, how the lending was, to how it has transformed in the recent times. I think, Satish, from the microfinance side, how have you been seeing?
So from the microfinance side, if you think about it, we have actually been at the forefront of tapping the new markets, the unexplored markets, right? Where every NBFC stops at 20 kilometers from a district base or from their branch, we start from there. So over the last few years, what we have seen is a surprising trend, right, which I think many of us have forecasted, but the rapidity with which it has become adopted is the adoption of mobile phones. Our surveys tell us 93% of our customers have mobile phones. That has allowed us to actually stay in touch with our customers and start thinking of newer and newer products that were hard to do much earlier.
Wonderful, wonderful. So let's get a little more different into the conventional side. PNB Housing Finance, you have been into housing finance. So from your side, how have you seen, the change in the area of, finance, and what transformation has taken place?
See, for knowing the change, I think we need to go back a few years back, if we can recall, how the lending business used to be. Anybody who was to take a loan for be it unsecured or secured needs to travel to the bank. That was also hesitation through some agents. Go to the bank, then get the documentation, the physical, the filing and everything. And I think I can say that higher the ticket sizes, more were the volumes of the documents. I have seen files while appraising the cases when we were quite young in this business. I think the 5 kgs to 7 kgs were only the banking files. The box files used to be, if you have to appraise SME lending loans. What has transformed now with the use of the digital tools at each stage of underwriting? I think the underwriting is more forward-looking now rather than historical predictions. That is where the new to credit customers has been tapped. That is where the hesitation of a customer has been done away, because the NBFCs have come into play to go to the customers at the locations where that bridge has been built in by NBFCs. Distance has been traveled, the use of digital tools has brought in at each stage, be it all kind of verifications are possible now. That has brought in that, removed that hesitation. To tap into the the new to credit segment, what he also mentioned, and as at PNB Housing we also have experienced this, and it has been a very successful journey so far.
Wonderful, wonderful. And of course, that bridge between the NBFCs and the customers, they have built themselves with digital transformation, and many a time they have taken help of fintechs as well.
Yeah,
so
definitely.
These are the two methodologies they have.
Fintechs has been a very good support. As I said, if I go back to the same line again, that banking statements and all, today how much time it requires, how much time by use of various tools available, you need not submit a single piece of paper and your loan gets approved.
Wonderful. So Aiswarya, you have been a CFO, and how have you been seeing the the advent of new to bank customers or new to business customers compared to the old existing to business customers? What have you seen in this entire scenario?
Sure. So I represent Kinara Capital, which is a new age fintech, and if you look at the evolution of how this segment has changed, About 3 to 4 years ago, more than 60 to 70% of the customers used to be new to business credit. They would have no formal credit at the back end, and all the problems which was discussed right now, like access to credit because of want of data, because of want of land or property collateral, and even the mere fact that reaching these customers used to be a challenge because last mile distribution was missing at multiple levels. So more than 60% of them used to be completely new to this financial credit. And after COVID, and if you see the situation currently, it's actually half, which means credit has come available to this segment of population. So right now, at least from our worldview of customers, about 30 to 40% still remain new to business credit, but 60% has come into the credit fold in some format, right? Which shows that the trend of this segment being, the ability of the segment to access credit has also shifted. So one could be definitely the digital adoption. There has been a sea change in terms of how the customers are even able to access everything through their mobile phones, right? Internet banking used to be the digital age technology before COVID, and now we're connected to so many different things. In fact, how the customer looks at all of the data points, how the customers' next level children are able to scrounge all of the data and get access to capital to their parents has actually been seen by us in our framework. So I think that a lot of milestones have been crossed, especially the last couple of years, in giving access to this particular new to business, new to banking kind of customers. Still a long way to go, but I think awareness, and as an ecosystem we've all pulled it together in the last few years, which is definitely showing results.
Wonderful, wonderful. Rohit, you have been a technology provider, and I know one thing for sure, that the technology providers are giving extra teeth to the NBFCs to get new to banking customers, especially with the kind of giving them the data points and trying to help them with the credibility, things like that. How have you been working with the companies in getting new to banking customers?
So, thanks a lot. At Lentra, actually, we only think APIs. So, and just to give you a well-rounded perspective from what we think about this is, basically, it is a resilient India story, and I think there are three factors which are coming in together to deliver much value for the end user, for the NTC customers especially. One is the government of India, the regulator, and the Indian entrepreneur. Right? On the government side, there is a huge push on the financial inclusion, and the JAM Trinity is one of the things which has led to a lot of NTC or new to banking customers come into the fold. There are about, I think, 50,000 crore bank accounts now in Jandhan, and 32 crores of that is backed by RuPay debit cards as well. So these people who are new to bank are now knowing how to use technology. Then there is the Aadhaar card, which has made the KYC a huge success and very frictionless. Much of it can be accessed through APIs. 99% of Indian adult population, I think, is already having an Aadhaar card. Then the third is the mobile, and this is where the Indian entrepreneur has really made a difference with indigenous applications, and average Indian is on the mobile maybe 2 to 3 hours, searching for locations, ordering groceries, ordering food, ordering cabs, and doing a whole lot of search. So there is immense alternate data that is getting generated. Besides that, I think whatever lending also uses some certain other data points, like led by payments, to GST, to frameworks that have come in, like OKN framework, the ONDC, where commercial traffic, much like Amazon government is trying to make. Then, so there are a lot of open API platforms that can very quickly access this data. In Lentra, we know that we have new to bank or new to NTC via APIs as a concept, where we access all of this data and can give a decision within seconds, which is kind of, even 4 years ago it was unheard of. So I think there is lots to be done, but a lot of data is already available, and if you have the right scorecard, right risk models, I think there is huge market that needs to be developed.
With that, I would like to welcome Abhijit also. Abhijit, hi, welcome. Abhijit is the Chief Technology Officer of HDFC Limited. He has been a banker with ICICI Bank, where I knew him for quite some time, and now, of course, he has spent quite a lot of time in fintech as well, and now he has gone back to the conventional lending, the big lender. So wonderful, Abhijit, to have you also into the panel. So we were talking a little bit about how has the digital lending transformed, and you have seen best of both the worlds. You have seen a conventional lending from an ICICI side, you jumped into the fintech side, and now you are once again with an old generation lender which you are transforming. So any experience you want to share in that?
So I think a couple of things which I see, with a smaller company or with a fintech, the ability to take risk is much higher, and the ability to take alternate sources of data, etc. Because that's the way the newer companies have learned how to do business, whereas in the older companies, you're looking at what you have done traditionally. So this, what's that Marshall Goldsmith book? What got you here won't get you there. It's clearly, the way we work is very different. However, given I think the forums that you all are doing, the kind of literature, and thanks to Google, so everybody today has a Google feed which is coming to them. So even the traditional companies are now looking at what are the sources of friction in each part of the journey. So part of the work that we are doing here, and thanks to the experience with ICICI and with the fintech that I worked in, we're looking at all sorts of areas where there's a friction. Traditionally, if I was an old school banker, I would have done, how can I take a scanned copy of this document? How can I provide a portal where I can update it? In today's world, having worked in a fintech, they're looking at how can I eliminate that data to be needed, and because India has such a beautiful infrastructure where you have account aggregators coming in. On the customer side, there is a lot of things that you can do and actually find out the credit limit of the person. So it's a massive transformation that's happening today.
Absolutely. And aided by the fintechs in the country which are coming in, it is going to be much more faster and much more agile. That is also a very interesting thing that is happening. I have a risk manager sitting next to you, and he is from Tata Motors Finance. And when all these engagements are happening with fintechs, and on one side the bigger technology companies are getting into the agile world of fintechs, there is a lot of risk also associated with it. Come one circular from RBI banning the credit line, everyone has to go back to their, banning the credit line to be issued to the credit card, they have to go back to their drawing boards to make a new strategy. Come one, circular about banning the Chinese app, which are surrogate using your NBFC licenses to do raw credit. Again, there is definitely a risk manager's play coming in. So what is this constantly evolving kind of risk paradigm in this fintech driven world in NBFCs, and how are you insulating organizations?
See, I think it happens across all segments that law takes some time to catch up with the changing societal and the customer and the technological paradigms which keep changing. The same thing is happening here also. Risk management also has to catch up. I think risk. So we will also keep learning as to what's happening. But fundamentally, I think what is most important is that in the lending business, what I believe is that the lending business, risk management is the core. Technology cannot be at the forefront and risk management at the beginning. No amount of technological advancement deployment should compromise the core, essential, traditional risk management norms or capabilities. And I'm not talking about regulations. Regulations is a different paradigm. The core essentials of risk management, that should not get compromised. So that is, I think, the biggest risk when you get into a technology-led engagement or technology-led processes. And that, as a risk management professional, you have to, as an organization, you have to be very careful. Because you can expand business, you can give superior expense, you can reach where no man has reached with the use of digital. But unless you apply a sense of common sense, unless you have a core traditional conventional collection mechanism in place, unless you understand the business of the customers beyond what is there on data, I think those are the essential things which should never get compromised when you adopt technology in a faster manner.
So, basic business fundamental has to remain, and the risk also has to be fundamental. Ultimately, all the technologies are building blocks above the existing fundamental. That is essentially what is true, right? And have you been also using technology to manage this risk?
Yes, of course. See, you can. The advantages with the use of technology and with the use of technology, your processing capabilities, the availability of data, all that is fundamentally increased. So it has made risk management much more easier, much more granular, much more better. So today, most of our businesses or credit decisions we do is based on scorecards, it's based on automated decision making. So that thing is there. But the lending business is much more beyond that. Right? So there is cyclicity of business, there is a vintage curve which happen. Today everybody would be very exuberant that the business is growing at 30%, 40%, 50% year on year. This is all early days. So unless you have the core things in place, that should never go compromise, and in fact that should go hand in hand with the use of technology.
Excellent. I want to come to Shekaar with a couple of more very interesting questions, but before that, since you are talking into the area of risk, Aiswarya, you have been a CFO. Would you like to actually share some thoughts from a CFO's perspective on these risks?
I actually love and echo what he said right now. Risk, yes, there's a lot of data around it now than earlier. We are able to get that data through multiple APIs, multiple connectivities to multiple platforms, because the kind of ability to get the data is the challenge, or was the challenge a few years ago. Now that we have the data, underwriting it is about how can we, fast track it to such an extent using AI and ML and bring in, I would say, more automated kind of risk modeling. Like at Kinara, we have more than 120 parameters with a data science engine which runs at the back end and evaluates each and every customer's ability to repay the loan, right? But at the end of the day, all the underwriting in the world is just probabilities, right? It's a probability of whether the customer will default, and if he defaults, hence what is the pricing I need to get from the customer so that I can manage the risk. And it moves into the collection game after that.
Great. So let me come now to Shekaar. Shekaar, you have been from the business side for quite some time. You have seen the business transform in different aspects, from the front office to back office. And today, a lot of automation is happening in the back office, and a lot of that is being pushed to the front office to create better experiences. How have you been seeing the change in the front office and the back office in this respective
See, basically, as we have evolved, the industry goes through its own motions, right? So tech, the way people are being seen, you can see it in two ways. One as a disruptor, the other as an enabler. So we see it as an enabler. The moment you start seeing it as a disruptor, that's when the problem arises. Once you start seeing it as an enabler, whether you're talking about fintechs or anything, you can use various models to fine-tune it. Now, coming to the back office, front office question, yes, the need of the hour is for not only seamless integration between both these teams, but also looking at how to serve the customer better with an integrated suite of product. So, for example, when the pandemic had hit, right, one of our key businesses is gold loan lending. And obviously that, mobilization was key because not many customers would be coming to your doorstep. I mean, you have to go to them. So that's why we devised an indigenous plan where the back office team, which was doing the entire processing, valuations, appraisal of the gold, we devised a very creative proprietary appraisal kit. And they had to accompany our front-end team, the sales team, and we used to go door to door and do the appraisal then and there and appraise the gold and deliver the monies online, fully in an integrated automated format to the customer within a matter of minutes. So that was some innovation that was brought between the collaboration caused by front and the back office teams. So I think tech is one area where both these teams need to be savvy about, at the same time about the objective of the customer.
Wonderful. And ultimately tech also ensures one more thing, that while all the all the wires and all the confusions remain down below, hidden below, and on the top it is looking smooth and experiential to the customer. I can see that tech guy smiling there, speaking about his experiences. Abhijit, you have seen it all. You have seen data evolving. You have seen data sharing happening. A lot of things happening with the play around data. Any new interesting aspects of how the data has evolved in the last few years?
What's happening currently is that there's a lot of focus on, what I see is companies are looking at getting external data, but there is also a need for us to look at what data you already have. So I keep recollecting this, one of my bosses told me when I was handling data analytics in one of the previous companies, that most data analytics people actually look for unstructured data, data outside of the organization, but there are bold bricks within your company which you don't look at.
Excellent. So let's get to one more important aspect. We are talking about, of course, Rohit, would you like to add something from the data perspective, since you are playing so much with data, with the API, data protection, data sharing, and data privacy. All these are very important. And of course, you have to ensure the right data with the right person. How is technology playing a role there?
So basically, one first point is you have data, but how do you triangulate that data? How do you make sense of that data? And what Rohit Tikku also said, that traditional, you have the data, but the traditional, because credit is not a new business, I think it is one of the oldest, 5,000 years or 6,000 years. That traditional sense should not be gone. The data has to reflect that in scorecards that you are preparing. So that's one use of data. How do you use that data? Second is how do you protect that data, because during transit as well as when it is at a database, it has to be secure. So data security is one of the biggest aspects. Even in co-lending, when you are sharing data between the NBFC and the risk that the bank is underwriting, the bank would like to know what risk I have underwritten, right? So that data protection is a very, very big thing. So the data has to be protected, and all norms, there are many norms. I think even our customers that we see have very, very strong CISO offices, and they drive in the security aspects, the vulnerability, penetration testing, all of that has to be there. You cannot do away. Then there are certifications that help you achieve some of these things, these controls like ISO 27001, 17, 18, SOC 2 Type 3. These are some of the controls that are needed, and we have to ensure that we abide by all of these things.
Wonderful. Thank you so much. Now let me go to the collections perspective. You have been in microfinance. The biggest problem is definitely collections, and for you, I think microfinance has innovated the way collection is done, for that matter. How has the pattern of collections changed in the last few years, and how has it been evolving now?
At the end of the day, right, collection is getting money back from the customer is a core of the lending business. Giving money is easy. Getting it back from the customer is the hardest part. So collection eventually becomes the core of any lending business. What we are seeing, right, is that, and our experience tells us that it's extremely important to have that physical touch with the customer. The moment you lose that touch with the customer, you ain't going to get your money back. Right? It's been proven worldwide that whatever analytics you do, whatever you try and do digitally, if you're going to lose touch with the customer, chances of you getting money back during tough times is going to drop. For us, collection has, I would say we are at the early stages of easing the mechanisms of collection. Our customers are, they all have bank accounts. We are seeing early signs of them using bank accounts, but most of them still live in the cash economy. So they generate their income in cash. And so from a mechanism perspective, while we have all the tech to collect money via UPI, mandates, e-Nash, etc., eventually the customer needs to get the money into the bank. before we can take the money from the customer digitally. Right? So that is, I think, we are at the early part of that journey where pandemic has begun to get the customers familiar with the idea of digital payments, become comfortable with the idea of digital payments. Right? Obviously, the government has done a tremendous amount of work in terms of making sure that the Jan Dhan actually gets used, DBT is being done in the customer's bank account. But the next, I would say, step change for us will happen when the customer starts transacting with each other digitally, where they start getting the money directly into the bank account. Until then, we've got a ton of technology, we've got a ton of analytics which tell us when the customer is looking risky, when are we looking at, when at a portfolio level there are things, at a geography level there are things that we need to start focusing on. And the technology is assisting us in our physical collection process. But eventually getting directly touch-free collection, I don't think is ever going to happen. But for our microfinance sector of customers, the next step change is going to be when the customer starts seeing money in her bank account.
Wonderful. Any thoughts to add from the housing finance perspective?
Yeah, see, from housing finance perspective, ours is a secured business, but still collections is as important as the business, because ultimately if you can't collect, I think we don't have right to lend. So collections with the use of technology coming in, and it starts not after the customer bouncing and you go back to customer and then collect. It starts when the portfolio is built. There's so much of data science, data intelligence available. We analyze the portfolios, then we have the pre-delinquency management. Today, with the use of all the tools available, we get what is good with us, what is bad outside, or vice versa. And it's more predictable that who is going to bounce now. Now, the game of probability which she mentioned, it is now in fact more predictable, and we have a set of customers that this will go very smooth as a green channel, or there is which will have a bottleneck. So strategies are planned accordingly, and of course the touch base is important. Ultimately, if he had to give money, he would have given in the first go. So definitely one has to reach out to the customer to get the money. But collections is also, the business has eased out over the years, and so is the collections also, with use of tools, with use of strategy management, and I think it's a smart collections today.
Wonderful. So, Shekaar, how have you been looking at the organizations removing the frictions in the business?
See, that's a very good question, especially in today's times with co-lending and BC and what have you, right? I mean, that's where most of the friction comes in when you have to deal with an outside external party. The friction is also internally when you have to smoothen out the workflow. So you have to look at a two-way process. One is using tech and going back to the drawing board to see how fast you can crunch the lead time it takes to get the product to the customer in whatever geography he or she may be in. Mm-hmm. The outside problem lies with that, especially like I said, coming back to the example of fintechs. Let's say you're partnering with a fintech, and the reason you're partnered is because you might be lacking a product suite that you don't have, but you would like to tap a geography, and the fintech has that product suite. So it's a perfect marriage, right? The problem starts when you start delivering it to the customer, because your systems should be able to talk to the fintech's partner. That is where we had to undergo a lot of iterations, and over a period of almost 24 months, we were able to fine-tune only those players whose DNA matches ours. When Rohit was mentioning about risk profile, that's very important. It's not just a matching of technology. The most important thing is to match the risk profile. I mean, am I going to lend to the same set of customers that the fintech is lending to, and vice versa? If there's a mismatch in that, no technology or nothing can save you from that. So that is number one, to match the DNA to almost 70 to 80%. Second is to match the tech readiness. The fintech, some of them may be very highly evolved, whereas the NBFCs or banks or financial institutions will take time to assimilate that technology into the overall system. And that is where we only look for like-minded partners, both from a risk profile to a technology-enabled profile, so that we can make sure that there's a smooth interface in between using a third-party app, and make sure there's a smooth interface and we can blend it.
Wonderful. Thanks a lot, Shekaar, for that. And Rohit, you have been into the risk management space, and you have seen a lot of, there is constantly a tussle between the business and the risk when it comes to any financial services business, and I am sure you must be also going through the same on a regular basis. What kind of strategies can organizations or are organizations thinking in this fintech world today to eliminate on one side the risk, but at the same time ensure that the business is also happy and have that kind of experiential customer there? So how are risk management teams looking at working? Because business has to come for everyone, be it for the risk or for the business or for the technology. How are you looking at this?
When I moved into the risk function, my erstwhile managing director told me, in fact he asked me as to what makes a car go fast. So I said maybe a good engine, a good driver, good power, good torque. He says no. What makes the car go fast is good brakes. Because then you have the confidence that you can go as fast as possible, and in case there's a problem, you can apply brakes. So he said the role of a risk function in a lending company is that only. That you have to enable the car to move fast. And that is the role, I believe, at least we in my organization, that's the role that risk function is taking. It is helping the growth of the organization, because we are at the forefront of designing new products, coming up with new policies. I am not just the risk officer, I am also the chief strategy officer of my organization. So we, as a risk function, takes the opportunity to identify new opportunities, to identify new growth opportunities, what you can do better. Because we are at the best position to understand the risks. Today the risk is not of that what you should not do. The risk is not doing something is the biggest risk. Not looking at the opportunities is the biggest risk.
Absolutely.
So that is the mindset with which we approach the business.
I think Abhijit, you have been from the technology side, and Rohit, what is that technology evolution that both of you see which will take the NBFC business or the business of lending or the business of financial services to the future? What are those three technology points that you think will make a lot of sense? Technologies of the future.
I think first, and India is doing very well in this regard, is completely moving into open APIs. And the accessibility and the consent-based accessibility of data, things like account aggregator, consent-based GST data that we can gather. So there are things that are happening there, but a lot of segment, for example, SCP, SENP, there is a lot of other things that need to be done, because for them the Kachapka records are still there, right? So that friction needs to be removed. I think that is one area that the government probably needs to work towards. The second is, once you have this data, the data will fly around quite a lot, right? Because now with co-lending, NBFCs are partnering with PSU banks, and quite a lot of PSU banks were earlier left out when the private banks were making a retail book. So they are now coming into the fore. So how do you basically ensure that the partnership does not break? Because it has been a start and stop story with co-lending. It started in 2012, then 18 and 20. I think finally it has taken shape. The systems can't evolve that fast, right? So how do you ensure that the systems with the banks and the NBFCs talk to each other over APIs and do that very efficiently? So I think that will be one of the crux. The other thing I think would need to happen is, like NBFCs pushed the banks in 2010 to 20. I think the fintechs are going to do that, and some alternate companies like Ola, Uber, Swiggy's may be selling financial products at your doorstep, right? So those are the things, those are the collaborations I see as future, and some of those things I think we need to.
Excellent.
There are three trends which I see. So one is this whole digital highway or 5G network which is coming in here.
Absolutely.
Especially coming from housing, I think what we all completely ignore is that the way the national highways are coming up, the infrastructure, it's very important for housing to come up. So if let's say Mumbai to Navi Mumbai road is a beautiful road and you can traverse the distance in 20 minutes, all of a sudden housing comes up. So you see in some of the states, even between, let's say, Lucknow and Kanpur, the way the highway is there, look at the kind of properties that are coming up there. So I think that's the second big change which is going to happen in the country. I think third big change which will happen is the privacy norms, I think, which we also talked about. The privacy and the need for privacy will push adoption of technologies like blockchain, etc., as we move forward.
Great, I think I had a very interesting conversation with all of you. I wish we had a lot more time. So great, thank you very much everyone. I take pleasure in thanking